Welcome back, everyone. Today, I'm going to walk you through a deep dive of the Austin, Texas market and through 5 different investment markets that I think are going to boom in the next several years. Let's get started. Welcome back, everyone. So today is going to be a longer video. There's a lot of good content here. I'm going to first walk you through who I am so that you know that I'm not just some random person telling you where to buy. And then I'm going to walk you through 5 key markets that no one's really talking about on the fringes of Austin, Texas. And it's really important to note, I think, for 99% of all properties in Austin, Texas, if you're looking at it from an investment standpoint, it's really hard to justify the numbers, right? But there's a lot of little pockets all around Austin, Texas that are in the path of progress that are definitely going to boom from the Austin boom. And today, I'm going to walk you through each of those markets, why I think these are the right markets, and what to expect from a potential return on your investment. So again, and we'll walk through each 5. This is a longer episode, so do, turn off your distractions, do focus. This is a lot of analytical data here. There's a lot of research, a lot of math, but I'm going to show you where these numbers are coming from and how we get there, okay? Now, the first thing that we're going to go through just quickly, I do want you to know who I am. So a brief bio. I grew up in finance, worked on Wall Street at Morgan Stanley, have my bachelor's in finance, my MBA in securities, law and finance. And after my MBA, I went to Cornell to extend my education there. Okay. I've been in real estate since 2011, been buying properties, been doing hard money lending, and a variety of other projects, flips and everything else. Today, I'm more of a developer and coach for those that are starting out. My most recent project is in Arizona, where we're developing 75 acres. We're doing a luxury resort, as well as we're a small community of homes that we're building. Okay. Again, I've been primarily switched now to coaching of clients that are starting out, as well as high net worth clients. And so I do focus in that. I've been doing that since 2015. And back in 2015, one of the things that I began to do is I had a method of how I picked markets. I wanted to understand how best can I get ahead of the trend before everyone else. And 2 markets that I picked before everyone else did was Huntsville, Alabama, and Cleveland, Ohio. Now, back in those days, I was probably 2 to 3 years ahead of the curve to get really good prices, and my investors and my clients benefited from that, trend-setting process. And my clients benefited from that analytical approach that we're going to go through today. And then lastly, of course, again, as I said, I do coach a lot of people. I have classes on real estate and stocks and investing and everything else. And that's in the Academy. I am the founder of the Academy. And there, if you are ever curious about courses or want to learn what I've been teaching or what I teach, you can all find it there, okay? So my method. Now, going back into 2015 to 2016, this method I tested. I wanted to make sure, how can I predict markets that as much as possible predict with accuracy large amounts of upside. And when I say upside, I mean return on your money. How could I predict markets that are ready for growth, ready for a boom, okay? And there's really 27 variables that I take into account when I look at metros and markets, right? And this is what I've coined the STOB index after my last name. And it's all based around a variety of micro and macroeconomic indicators, okay, as well as socioeconomic indicators. But when you really drill down, the main ones that stand out, right, is median income. Are you seeing median income growth in certain metros that are faster than the national average? And that's a really important thing. And GDP growth rate, again, is the economy that you're looking at growing faster than the national average? Population growth rates. In my book, I go through a lot of these as well, and I deep dive how we come up with these numbers. But population growth rate, again, not only do we want it to be faster than the national average, we want to be tracking where the millennials are moving to. Millennials usually set trends, or the younger crowd sets trends. So we want to be understanding where are they moving to and what to expect as they get into their, the middle age of their life. Okay. Diverse economy. I can't stress this enough. Florida, for many reasons, has been a market that I have avoided, because I have always felt that for the majority of Florida, their economy doesn't have a variety of industries. It has 1 or 2 main industries. And right now they're hurting from COVID because they're primarily based in entertainment and hospitality. Well, if they had a variety of other parts of the economy, it would only be a fraction of the impact, and generally the economy would be okay. So one of the key things I look for is how diverse is the economy? And you'll see in our reports here today how I go about looking at that. Affordability, right? A great leading indicator as to what to expect on price appreciation. School trends. I love the Southeast from an investment standpoint, but they're notorious for having bad schools. So if you go to the Southeast part of the United States, it's really important to look at schools at a much more micro level than, let's say, in the Northeast. Crime, another one. Obviously, you want to be in cities and metros that have safer environments. And then lastly, and very importantly, how much opportunity will you make in this market or in these deals? Okay, so we take all these variables into account, and then we come up with a score on each metro. And that is exactly how I was able to predict Huntsville, Cleveland, and now Austin way ahead of everyone else. And this is also why I'm predicting a lot of appreciation in the future, while so many of these, quote, gurus are out there predicting a massive crash. Okay. So let's get into the actual report itself, okay? So we're going to look at 5 different markets, and they're all going to use the exact same process for evaluation, okay? The first one, quickly, here are the 5 markets. Now, some of these are hard to see. You'll see the 2 little dots. I'll start from the bottom and go to the top. The bottom market is Kyle. This is about 30 minutes from Austin, okay? And keep in mind, almost all of these markets are going to benefit from the Austin boom, all the jobs. You do have the tech jobs, the semiconductors, and the Apples in the north. And then you have the manufacturing, the Teslas, and the biotechs in the south and southwest. Okay. So each area will have their halo effect, if you will. Now, I'll tell you that Georgetown, for reference, is about 40 minutes from Austin. Okay. And Kyle's about 30. So Killeen's about an hour and 20 minutes from Austin. So they're all relatively in the same vicinity. People do drive further in Texas than other states. So while an hour drive might seem like long to you, in Texas, it's not the longest drive. Okay. So again, the bottom circle is Kyle. Going up, you'll see another small circle that is Manor. Going up to that is Georgetown, which is a very nice community. And then going up from there is Jarrell and then Killeen. Okay. Now, one thing I'll say quickly about Killeen is Killeen has a massive military presence. And so there is some stability to that economy just from that standpoint alone, okay? And so if you haven't seen why, first of all, I like Austin as a market, I'll put the link above. You can go there after this video to see why I think Austin's going to boom. I'm sure you've seen it in the news if you're looking at this video. So these are all areas that I'm looking at for investment, many of which I already own properties in, okay? So when we look at the process, again, I had that 27 variable process that I evaluated Metro. That's already been done. Austin has all that in place. But digging deeper, we're going to look at the home price, the rental prices, the property taxes, and then a big piece of it is what to expect on a cash flow. How much return on your investment will we expect for you to make? Okay. We'll look at the school score, the crime score, what I think to be is the upside potential. And that's mostly from the growth and financial standpoint. 2 really important areas is what we expect or what we have been seeing for population growth rates. And this is measured over a 20-year period. So we're going to dig into that for a second. We're going to dig into the median income growth rate. Again, the faster the income growth, the more they can afford to pay for rent and for a home. And that's going to equal the next column, which is faster estimated appreciation rates. Okay, very important there. And then that all combines itself, and you come up with what we consider neighborhood score. How good is the financials or the financial score? And then as an investment, combining both neighborhood and financial, what is the score from a pure investment standpoint? Okay. And then we'll net that all out by saying, okay, well, great. We have the scores for investment. What do we expect for the estimated return on your money over 5 years? So the first one is Kyle, Texas. Again, 30 minutes south of Austin. It's going to see a lot of growth in the future, as all these markets will. And it's relatively an affordable place. Now, again, we're going to look at some of these things. Now, one of the key things that I found surprising about Kyle is that the income growth for the last 5 years has been relatively flat. Now, we have been seeing an uptick in median household income, and I expect that to increase as people can no longer afford the core of Austin. They will move to places like Kyle that does generally have good schools. Okay, so we've seen some growth rate faster than the national average as of late, but generally not a booming median income growth rate. Going down below, you can see here, this is the diversity of the economy. This is what I'm talking about. And what you'll see here is that it's fairly diverse. there's really not one main area that has more than 15% of the overall industry, right? The one to be concerned about in terms of COVID is the one down there that says accommodation and food services, right? So not a massive part of the economy. And generally, this is a fairly diverse economy, okay? Median income sales price. We're at about 250 right now in Kyle, and I expect that to speed up drastically. You can see that from 2020 to 2021, the appreciation rate has very quickly risen, and with that, affordability has decreased. And typically, when affordability decreases, the homeownership percentage also decreases. Now, most people in Kyle do own at a 71% home ownership rate, which is higher than the national average. Investors see that as sometimes as a good sign or a bad sign. You do want a strong renter's market if you're going to make it a rental, but higher home ownership does usually equal higher appreciation rates. So a 70% tells me that there's enough opportunity to get renters in there. People do want to own, do want to live there. It does have good schools, okay? So what does that mean? Well, when you break it all down from the numbers, the average home price is about $250,000. You have an average rent price of $1,800, which equals a rent to value ratio of 0.72. Now, in Austin, you got to be at around a 0.7 to 0.8% rent to value ratio to cash flow, which is why I have this in here. I want to show you where we land on that scale. Property taxes, everyone talks about high property taxes in Austin. They're not that high. I mean, 2% is higher than the national average, but generally it's not as high as New Jersey or parts of Cleveland or New York. So 2% is the property tax here in Kyle. When you factor all that in, what to expect from a cash flow standpoint, well, just from your return from your cash flow, it's around a 6% return, which is about the average for the nation. Most rentals are getting between 6 to 10% across the nation. Okay. Now, but what you get with that in Kyle is you get a great school district, very low crime, and substantial upside potential. And that's indicated by the population growth rate, an annual growth rate of 12.3%. Now, that is 12 times the national average, right? So people are definitely moving to Kyle. With that, I expect more demand on the inventory. And for that reason, you're going to see a massive appreciation forecast of 56% over 5 years. Very big, okay? We have some median income growth, not too fast, but we do have some, okay? And that will go up as people who have more money move to Kyle. So we have a neighborhood score of 9 and a financial score of 8 for a investment score of 8.4. Now I have a threshold whenever I work with clients that your score for investment has to be at least a 7.5. So we do meet that threshold. And over a 5-year period, when you combine the cash flow as well as the appreciation, you could expect a 13.5% annual return from this market, okay? So a pretty big upside for a growing market. And again, not many headwinds for the city of Austin, okay? All right, the next one, Georgetown. Now, Georgetown is if we go back to the map here I showed you earlier, it is more north, about 30 to 40 minutes. It's a quaint town, very family-oriented, really good schools. It's a charming downtown, definitely growing, okay? You can see here that the median income is around $71,000 a year, and that's growing 5.4%. People are moving to Georgetown as Austin becomes too expensive to live in, right? And so I foresee this to continue. You do have rather high-paying jobs from Austin, but they're moving to Georgetown to get a bigger bang for the buck. And you can see that down below, the risky green or the COVID section is a very small part of the overall economy. Again, very diverse economy. You have very good jobs here, a very stable market indeed, okay? And here's the downside. Georgetown has a $325,000 average price point. So there's not a huge amount of upside in terms of the appreciation. You can see the graph there that it's gone up 12% just in the last 12 months, right? So a massive price appreciation. It will continue for a while, but there's not as much upside as the other markets here. You can see that most people own 74%. So people would love to rent there, but there's probably just not that many rentals in the market. Now, when you look at the score and compare that to Kyle, a higher price point, you can get rentals around 305 or so with a rental price of $2,200, which coincidentally enough is the exact same rent to value ratio as Kyle at a 0.72%. And by the way, rent to value ratio is simply figured out by taking the rent price divided into the home price. Okay. Property tax is a little higher, 2.2%, and 2.2% is about the average in Austin for non-new builds. New builds have an additional percent on top of that for a variety of things. I won't get into that right now, but Austin has around a 2.2% tax rate. Unfortunately, because of the tax rate, your ROI is a little lower, 4.8%. Not the greatest, but going over to school, 10 out of 10. Crime, 10 out of 10. Upside potential is only a 6. Again, people have been moving there, indicated by the growth rate of 5.6%, which is about 5 times the national average. Definitely moving there. You do have strong median income growth, but affordability is going to be an issue here in the next few years. For that reason, I only foresee around a 35% appreciation over 5 years, which is still phenomenal. It's just not as good as some of these other markets. So neighborhood score, a 10. Financial score, not so great at a 6. Your total investment score of 7.8 with an estimated return on your money over a 5-year period annually at 10.3%. Okay. 3 more to go. Jarrell, one of my favorites. Jarrell, Texas. Now, if you go back to the map, this is just north of Georgetown, as you can see here, about 10, 15 minutes. Okay. But this town will benefit from people moving out of Georgetown into a more affordable market. But this is an interesting one. Look at the graph here. People have already been moving to Jarrell. This will be the highest median income of all of our markets with a 1-year growth rate of 21%. People with money are moving to this market, okay? That has a lot of good signs for the appreciation, okay? I mean, this graph is just massive here, okay? Diverse economy, a very small segment is the COVID segment. High-paying jobs, people are educated, a very strong market indeed. But here's the kicker. The median home in price is only about 210, 220 or so. Now, this is going to skyrocket. It's just the way it is. So the timing is now, but you can see that it's been on a great incline. And because it's affordable, the ownership is around 74%. So people do want to live here. You can see that the drop-off is happening. So people are moving there to both rent and to live. Now, comparing this to everything else, pretty good numbers. You have a home price of 210, a rental price of 1650 for a rented value of 0.79. Property tax is a little higher, but you get about the same return as Kyle, 6.1 in Kyle, 6.3 in Jarrell. School score, 7. Crime score, 9. Upside potential is an 8. Okay, we're seeing a pretty big population growth rate, almost 8%, massive median income growth rate. And I think affordability is very, very good right now. I actually see a 78% appreciation rate over 5 years, which sounds crazy to even say, but I do think that's realistic. That's about a 10 to 12% appreciation year over year. Okay. Neighborhood scores, pretty good neighborhoods, good financial opportunity, a very solid investment score of 9.1 with an estimated annual return on your money of 16%. Very good. Killeen, Texas. This is the most northern city. This is the one with the Army base. So a little lower income here, but a very healthy growth of 3.1% year over year. Very strong. Now, a good majority of the jobs here are made up of the military base, which is a good indicator of stability. There is some COVID industry here, but generally a very diverse economy. Now, with a lower median income comes a lower affordability level, okay, which means only so much upside in the appreciation is possible. Now, what's interesting about this market is that home ownership is much lower than the national average. So you have a lot of renters here, mainly because of the military base. So that's a good sign for when buying rentals that you'll have plenty of demand to make it happen. But the secret's kind of out. You can see this massive incline here of almost more than 20% over 2 years. So appreciation is already booming in this market. So expect to see more of that. And what that means from the financial standpoint, check this out, home price 185. This will be the cheapest market of all of our 5 markets. The rental price is around $1,450 a month. And all these rentals are based on a 3-bedroom, 2-bath, 1,500 square foot home. That's a solid rent to value ratio of 0.78. Property taxes are a little lower, around 1.9, so you're going to get a little bit better cash flow. Schools are not the best. They're fine at a 7. Crime's not the best. It's fine at a 7. Upside potential is around a 7. Okay. People are moving there about 3 times as fast as the national average. You do have some income growth there, which is good. And so a 5-year appreciation rate of around 50%. Okay. So I think you know the score here. We'll go right to the investment score of 7.6, looking at a 13.8% average return on your money. Okay. And the last one, Manor, Texas. This is the closest one to Austin. If you go back to the map here, very close to Austin, about 30 minutes to downtown. Okay. So going back to Manor, you'll see that it's kind of been an up and down market. It has regained strength. There's new development happening there. People are moving there. The income growth is happening at a 6% clip year over year, pretty strong. It's a relatively diverse economy, like all of Austin. So that's there. You have a very high home ownership, right? So it's going to be very hard to find inventory on the market. People do want to live there. And you can see, again, a steadily increasing price at around $240, $250. You can get rentals for around $220 to $230 in Manor. Okay. So when you compare Manor to the rest, a $230 price point at $1,750 rent gets you a decent rent to value ratio. Property taxes are about the average, which unfortunately does bring down your return on your money. Schools are the worst of all these 5, but still fine. Not the best, not the worst. Crime's about average. And so it has decent upside potential. But this is the fastest growing city of all these 5. The population has grown at 14% annually year over year. So expect to see a lot more demand on prices and rental prices. Income growth has been pretty good as well. And so we're estimating a 41% appreciation rate over 5 years. So you put that all into perspective, you have a 6 on neighborhood score, 7 on financial score, and a 6.7, which does not meet our threshold. It's slightly under where we want to see. And while the forecast is around 11% ROI, I'm ruling Manor out as an option. What I do like of these 4, obviously, is Jarrell. I think Killeen's a very interesting market. It's very affordable to get into. And with that Army base, that's a lot of stability. So where I'm putting my money is in Kyle, Jarrell, and Killeen. Okay.